You know the story, right? The one that says the stock market is this incredible engine for our economy, the place where our savings go to build companies and create jobs. It's a really powerful idea. But what if it's not really true? What if it's mostly a myth? In this explainer, we're going to pull back the curtain and see where the money really goes.
The whole belief is pretty straightforward. When you buy a stock, your money helps that company innovate, build new factories, do more research. It's supposed to be a direct line from your investment to real-world progress. And yeah, that's the story we're told over and over. But what if that's a huge misunderstanding of how the market actually works? To see why it's a myth, you have to understand a simple but really critical truth. There isn't just one stock market. Nope, there are two, and they do completely different things. Honestly, getting this distinction is the key to understanding everything else.
So first, you've got the primary market. This is where brand new shares are born, like in an IPO. But then you have the secondary market, which is much, much bigger, and that's where all the existing shares get bought and sold. They sound kind of similar, but believe me, their impact on a company's bank account couldn't be more different.
Okay, check out this chart and focus right in on that capital destination row. In the primary market, a company sells new shares and boom, the cash goes right into its bank account to be invested. That's real capital. But in the secondary market, which is most of the market, we're just trading shares back and forth with other investors. The money goes from my pocket to yours. And the company? It gets zero, nada, nothing.
This is honestly the perfect analogy. The secondary market is basically a giant, super fast used car lot for stocks. If you buy a used Ford from your neighbor, Ford Motor Company doesn't see a dime from that sale, right? It's the exact same principle. The connection between you investing and the company actually getting funds to build things is totally broken.
And just how big is this used car lot? Well, get ready for this number. Some estimates say it accounts for up to 98% of all stock trading activity. Yeah, you heard that right, 98%, which means the vast majority of what we call investing isn't funding companies at all. It's just trading.
So, if the market isn't really funding new business investment, then what on earth is it doing? Well, this gets us to the real heart of the issue. The way the market is set up has created this powerful incentive for corporations to stop focusing so much on creating new value and to focus instead on just extracting existing value for their shareholders.
We've basically shifted from an old model of retain and reinvest, where companies would take their profits and plow them back into the business, to a new one, downsize and distribute. That's value extraction. Instead of spending cash to hire more people or develop the next big thing, companies are now spending billions to buy back their own stock, which just juices the share price for a short-term hit.
And let's look at a real-world example, because it's pretty wild. A House Oversight report looked at the 14 biggest drug companies. What they found is staggering. Over a 5-year period, they spent over $500 billion on buybacks and dividends. That's $56 billion more than they spent on research and development. The priority couldn't be clearer: reward shareholders, don't necessarily discover new cures.
And if you want to see this in a single snapshot, just look at Amgen in 2018. This chart says it all, doesn't it? The company spent more than 5 times as much on buybacks and dividends as it did on R&D. This isn't some accident, it's a strategy, and it's driven by a system that rewards this kind of behavior.
And this stuff has tangible, sometimes incredibly dangerous consequences. I mean, look at Boeing. Before the tragic 737 MAX disasters, the company had poured billions and billions into stock buybacks. Critics argue that was money that could have and should have gone into engineering, into safety, into innovation. It's like financial engineering created this illusion of a healthy company, while the actual foundation was crumbling.
This all leads to a much bigger problem, right? We're seeing this massive split, this decoupling between how the stock market is doing and how the actual economy feels for most everyday people. They're just not connected anymore.
And it's a question I think we've all asked at some point. You see the headlines screaming about new all-time highs for the market, but you don't really feel it in your paycheck or see it in your community. It's like the market is playing an entirely different game by a completely different set of rules.
And here's the kicker. All this financial activity, all these buybacks, they can actually make our big economic numbers, like GDP, look pretty good. The market goes up, but we're not actually creating anything new. No new services, no better products. The result is just that wealth gets more and more concentrated at the very top. You can see this so clearly when you look at that widening chasm between productivity and wages. For decades, it was a simple deal. As American workers got more productive, their pay went up right alongside it. Well, that link is broken. Now, all the gains from new technology and efficiency, they're not being shared. They're being funneled straight up to shareholders.
Okay, so if the stock market isn't the big engine of investment we all thought it was, then what is? And how could we start to build an economy that's actually, productive again? Let's see what the sources suggest.
The reality is, real business activity has always been funded mainly by three things. First, good old-fashioned bank loans. Second, and this is the big one for innovation, companies just reinvesting their own profits. And third, public investment, government funding for basic research and infrastructure. The stock market, it's really just a bit player in this whole story.
So what's the path forward? Well, some economists have laid out a pretty clear plan. First, ban stock buybacks to force companies to reinvest in themselves. Second, change the rules for executive pay so it's tied to long-term value, not short-term stock pops. Third, give other stakeholders, like workers, a real voice on corporate boards. Fourth, reform the tax code to reward actual investment. And finally, use public money to kickstart big collaborative projects. It's a roadmap back to a more productive economy.
And that really brings us to the final question, doesn't it? The system we have right now, it isn't some law of nature. It's a set of choices. And for decades, we've made choices that reward extracting value way more than creating it. So the question we're left with is, what would our economy really look like if we decided to choose differently?